Welcome to Macro Musings, where each week we pull back the curtain and take a closer look at the most important macroeconomic issues of the past, present, and future. I am your host, David Beckworth, a senior research fellow at the Mercatus Center at George Mason University, and I'm glad you decided to join us. Our guest today is Marc Giannoni. Marc is a managing director and the chief U.S. economist at Barclays Capital. Marc is also a veteran of the Federal Reserve System and the Swiss National Bank. Marc joins us today to discuss the Fed's framework review, Fed independence, the future of R-Star, and more. Marc, welcome to the program.
Thank you very much for having me, Dave.
Well, it's great to have you on. Now, I think I first ran into you at a Hoover Monetary Policy Conference. You may not remember this, but I was sitting down on one of those round tables for a lunch or dinner, and you were there, and you introduced yourself. I was like, Marc Giannoni, I loved your 2006 RE stat paper, Has Monetary Policy Become More Effective? And we'll get to that later in the program, because that was one of my favorite papers in a long time and deals with identification and the challenges we face as macroeconomists. But it was such a clever, and I think such an important paper when people are doing economic analysis. So I met you there, and then I think I ran into you at the Jackson Hole 2019 conference. You were the research director. So tell us about your career, your journey. You're at the Federal Reserve, now you're in the private sector. Walk us through. And you're from Switzerland originally, I learned. Fascinating.
That's true, yeah. No, very good. Again, thanks very much for having me, David. So I mean, pretty early when I started economics, and as you said, this was in Switzerland, way back when, I was really fascinated with monetary policy. I dreamed of working one day in a central bank, and my very first job out of college was at the Swiss National Bank. I started out as a junior economist. I was tasked with covering basically Italy and France. And right away, right after I started, I was thrown in the deep end, I guess. We had the European monetary system crisis shortly after I began. And I had to sort of make sense of that and report to the big bosses about that. So that was quite an exciting time. So I worked about 5 years at the Swiss National Bank and kept wanting to learn more about economics. So that pushed me to the US eventually to pursue a PhD. And I was fortunate enough to be able to go to Princeton University. So that was actually an incredible time in monetary economics. I think the field there was undergoing like major shift. I had the privilege to be working with some amazing advisors. I had Mike Woodford as a primary advisor and Ben Bernanke, Chris Sims, as well as part of my committee. So it was like a great, very inspiring committee. I worked for several years as Mike Woodford's research assistant, also while he was working on his book, Interest and Prices, which has since become kind of a cornerstone, I think, in monetary economics. So really, really interesting times. So I was really fortunate, I think, at that time. And then continue to work along with Mike on several exciting research projects for many years, actually, focused on optimal monetary policy. This was mostly technical work, but work that influenced a lot the way I think about monetary policy now to this day. So that was kind of my Princeton days. And then after that, I joined again a central bank. So I went to the New York Fed in the research team there also just in time for the 2001 recession, which was also quite something, quite interesting. But a couple of years later, I moved back into academia. I joined the faculty at Columbia Business School. So I spent nearly a decade at Columbia between teaching and doing research, continuing these research projects with Mike and with Jean Boivin, the paper that you were referring to before, but continued to work also closely with people at the New York Fed. So eventually I returned to the New York Fed full time and focused on monetary policy issues, R-Star issues, as you alluded to, and policy advice by briefing the president. Then came a call from Rob Kaplan, who was president in the Dallas Fed, and he asked me to join him and serve as director of research and chief policy advisor. And so off I went to Dallas, basically, leading a pretty large research group, working closely on FOMC issues and engaging also with the board of directors there and businesses across the district, which brought to me like a very different, very, new set of interesting issues to work on and people to talk with. And so now 5 years later, I've found myself back in New York, this time in the private sector. As you alluded to, joined Barclays as chief U.S. economist, where I am today. And there I lead a, U.S. economics research team, and we focus on the U.S. economy still. Monetary policy, trying to share our insights with Salesforce, traders, clients, policymakers, the broader public.
Yeah, I've seen you on TV a few times in that role, and I have a few of your research notes. But I didn't realize, Mark, that you were a part of what my former colleague, Scott Sumner, he has this paper. He calls it the Princeton School of Macroeconomics. That late 90s group, Ben Bernanke, Paul Krugman, Mike Woodford, I guess a fellow grad student at the time, Gotti Ergensen, Sims, all these big names that we're thinking long and hard about. Oh, Lars Svensson as well. They were all thinking long and hard about Japan and the deflation. So you got exposed. That's pretty remarkable.
Yeah, it was a great time.
Yeah, other thing I want to highlight is you went to the Dallas Fed, and I had a good friend there, Evan Koenig, and you remember him. He's a big champion of nominal GDP targeting. So am I. So we naturally connected.
Yes.
But you've had quite the run. So that's really fascinating to see your career. Now, you mentioned you were the research director at the Dallas Fed, and you were there during the lead up to the 2020 framework review. You're a part of that process. And I want to get into the current one, but tell us about that one. What was your role? How did you see it unfold? Give us the backstory.
Yeah, so I was called at the time to join in a so-called steering committee that involved 4 senior staff members across the system who coordinated the research effort from about 80 researchers across the Fed system that focused on that framework review. And the other 3 members were initially, at least, Thomas Lauber, the late Thomas Lauber, a great friend of mine, head of monetary affairs at the board at the time, who unfortunately left us way too early. Jeff Furr at the time at the Boston Fed, and Dave Altig. And together we were part of the steering committee thinking about how to structure the research program around that framework review and basically channeling all the work from all these wonderful researchers across the system and then present it to the FOMC. So for the good part of basically the second half of 2019, early 2020, we spent quite a bit of time briefing the FOMC at every FOMC meeting, presenting new results and moving forward the agenda, which then gave rise to that 2020 statement on longer run goals and monetary policy strategy. So that was quite an interesting episode as well. Of course, that came, or at least towards the end of that process, we went through the COVID period, which brought a whole set of new challenges, but we were very much focused on that reform and that statement on long-run goals and monetary policy strategy.
Do you think the 2020 framework, which is called FATE, a popular name is FATE, Flexible Average Inflation Targeting, do you think it kind of reflects the legacy of the Princeton School of Macro because it has a makeup policy term in it? You know, the whole notion that if you go way below, you're going to catch up. And I'm someone, I think it's important. Now, we don't always need makeup policy, but if you have something like 2008, the Great Depression, I think makeup policy is essential. So you guys are able to bring it in. In fact, Rich Clarida, I think he framed this in terms of as a version of Bernanke's temporary price level targeting. And Bernanke, of course, is part of that Princeton School of Macro. So how do you think about that 2020 framework?
Yeah, and I would say Rich Clarida was like instrumental during the process. He was vice chair at the Fed, of course, and we were reporting directly to him. He was basically leading this whole effort at the time. But I do think this FATE feature was really important at the time. I still do think it's important in general. And I guess as we talk about the current reform, we can talk again about the importance or not of including FATE as part of the policy strategy. But I do think it's basically an automatic stabilizer that helps the Fed provide accommodation when you need it and when the typical instruments like the funds rate are being constrained by the effective lower bound.
So let's jump into the 2025 framework review. Just announced, Chair Powell announced it. Of course, it didn't get a whole lot of attention because there's other things going on. Now, I know I was closely watching that part of his speech. Everyone else was watching the first part of his speech about rate cuts and Fed independence issues. But I think this isn't important because, like you said, makeup policy or level targeting or forward guidance, all those elements are essential if we get stuck in a world like we were in the 2010s. And it, on the surface, at least, it looks like we went from fate to fit. So flexible average inflation targeting to flexible inflation targeting, although there's some caveats, some nuance. So how do you read the new framework?
So far, the FOMC has released an updated version of its statement on long-run goals and monetary policy strategy recently at the Jackson Hole conference. This is a foundational document that specifies the FOMC's policy goals and its approach to achieving those goals, so namely its Fed's reaction function. So in a sense, it provides the basis for the committee's monetary policy decisions. Now, the FOMC, as I understand it, is working on other aspects of its framework review at present, and I expect it to come up with enhancement to its communication policy sometimes later this year. So that would include, I suspect, enhancement to its summary of economic projections, potentially its dot plot, something like that in the fall. Now, in regards to the statement on longer run goals and policy strategy, it basically came in largely as we had expected. Actually, the FOMC had given us some advance notice in their minutes earlier this year, and I think it made a few changes that were quite warranted. I mean, for one, it no longer refers to the fact that neutral rates of interest have declined. This was a feature in 2020. That's what we had seen in the decades preceding the 2020 review. Now, since then, there's a lot of uncertainty about the path of rates, but they have likely not declined further. And so I think it's appropriate that the FOMC remove that part from the statement. They also de-emphasized very much the concerns about hitting the effective lower bound on interest rate, given the recent experience with elevated interest rates and elevated inflation. So that's not a concern at present, although it could be a concern in the future again. We could end up again at some point at the zero lower bound or at the effective lower bound, and Fed policy may want to have a strategy in place to handle that. Now, as you said, the FOMC removed the fate strategy from its statement and returned, I think it's accurate to say that it returned to the fit, flexible inflation targeting without the averaging part. It has some merits in the sense that it's simpler, it's easier to understand. You know, they are looking to achieve 2% over time. So there's no ambiguity about that. But I do think they lost something by removing fate. It was, as you said, intended to provide more stimulus at the effective lower bound, in effect by generating higher inflation expectations when inflation expectations were drifting down, when inflation was below the target and interest rates constrained by the zero lower bound. By generating higher inflation expectation, you are basically lowering the real interest rates. You are providing more stimulus. And that, in a way, creates an automatic stabilizer for the economy. So I think it has a very desirable feature that you see in other strategies like price level targeting, for instance, that helps stabilize the economy quite effectively, I think, when you need it and when you are constrained by the zero lower bound. Now, in its place, the FOMC revised the statement, but notes that the Fed is prepared to use its full range of tools, as they say, to achieve the goals at the zero lower bound. They don't really specify what that means, but I suspect this refers to the balance sheet and maybe forward guidance to some extent when they are constrained at the zero lower bound. Now, there is some disagreement about how effective the balance sheet is if you don't have a strategy that aligns with it. And so I think that's to be seen. But I personally do think it's unfortunate that the FOMC dropped the fate part. I fully appreciate it's not relevant now, may not be relevant for a couple of years. But if we do return to a low inflation environment, low inflation, low interest rate environment, it's a tool that could potentially provide the stimulus when you need it. And the strategy has relinquished its tool at this point.
Yeah. Like you, I noticed that they seem to hedge their bets with the quote full range of tools at the zero lower bound. They also got rid of the shortfalls, but they
Right.
didn't go back to deviations. They talked about, well,
Yep.
there may be times where the economy can run above maximum employment in real time and not have price stability. So I feel like they're hedging their bets. So they've gone back to fit, but they're allowing elements of fate kind of lurking in the background. So in some ways, I would say this is a little more confusing. Now, I know fate was confusing because it was makeup from below, not from above. And I think that was a hard point to get across to the public. And that, Mark, is why I think something like a nominal GDP level target is a whole lot easier to communicate, because it is hard to, we don't want to tighten policy in the face of supply shocks. We want to see through them. And that's in my mind, at least, it's a whole lot easier if you frame this in terms of nominal income growth or spending growth. But in any event, so they hedged their bets. They got this new framework. I guess, Mark, if you could wave a magic wand and you were given the power to design a framework, what would your ideal framework look like?
Well, I think it has a lot of elements of that ideal framework in the sense that they specify the inflation target, 2%. That's pretty clear. We can debate the number. Should it be higher? Should it be lower? But I think having a number brings a lot of benefits.
Yeah.
Ultimately, it helps anchor inflation expectations. I think it gives a good sense of the strategy. I think they could be more specific on a number of points. I talked about, my preference for fate in general. If
Yep.
you want to have a framework that's robust to a broad set of environment and not just the conditions that we've been over the last 3 years, so other configurations. So I do think it brings that feature. You alluded to the shortfalls. I think this is another part that, it got dropped from the statement. But there are exactly as you said, there are elements of it still there, right? I think they suggest that the committee will partially return to its prior strategy of tightening policy more preemptively when the employment is perceived to be at about its maximum level, but not quite, because they left this option to not tighten policy when the unemployment rate is low, if the FOMC judges that it's not feeding undesirable price pressure, let's say. And this is, as you said, I think somewhat confusing. Obviously, we don't know and nobody knows what maximum employment is. And certainly we don't know in real time what maximum employment is. It's something we can estimate over time, but there's a lot of uncertainty around that. So obviously we need to take these estimates with a grain of salt, and there's judgment that needs to be applied. But I think what a good framework has is clarity about how you deal with that judgment and what you are trying to achieve. And to me, saying that, it's sometimes okay to let employment go above the maximum level of employment, or at least what we in real time estimate to be the maximum level of employment, is somewhat confusing. They also talked about, or reemphasized, I would say, the importance of having anchored inflation expectation. And obviously that's very important. I think it's good that they added that, but it is a little vague as well, and we've seen, for instance, this year inflation expectation move up longer run. Some estimates of longer run inflation expectation move up quite a lot. Others have not. And the Fed FOMC participants have consistently repeated that longer run inflation expectation remain anchored. I think that creates a little bit of confusion as well as to what exactly are we talking about when we say that inflation expectations are anchored.
Yeah. A lot of interesting questions here in this framework. So it'll be interesting to see 5 years from now when they revisit this, what happens, any changes to it. You mentioned the 2% inflation target being explicit is very useful. Maximum employment, we don't know what it is in real time. So do you think it's better to leave it undefined since we don't know what it is?
Well, I think it's appropriate that the FOMC, as it does in its statement, does not give us they give us a number for inflation, 2%.
Yeah.
But they don't give us a number for natural rate of unemployment or what they think of maximum employment, what the level of that is, or what the trend of that is, just because of the considerable uncertainty around that. But I think as part of their communication, they could give us, and this may come later, who knows, they could give us estimates of what they think it is. We know from the SEP, let's say, what they think the longer run neutral rate of unemployment is. We don't necessarily know what their estimate of the shorter run neutral unemployment rate is, but they could give us more information about that, about how they judge where the economy is relative to what they are trying to achieve and in what direction they have to move the economy with their policy instruments.
So we're talking about the framework review, and I think both of us think it's an important discussion and maybe more attention should be given to it by the media. But at the time that this speech was given by Chair Powell, there were other things brewing. We had questions about whether it'd be rate cuts or not. But then the other big lurking question, of course, is Fed's independence. And so, Marc, at some level, I wonder when we have these conversations about the framework, it kind of assumes we have Fed independence so it can make these choices, redesign its framework, do things. And there's been a lot of questions under the current administration whether that independence is being compromised. And I don't want to get into all the details. Listeners know what's going on. But I do want to frame it a little bit different than I think many people are framing it. So, former Fed Chair Bernanke and Yellen had an op-ed in the New York Times. I believe Yellen had one just recently in the FT as well. But their angle on it was very much what I would consider like political independence or the norms. The president doesn't bully or push the Fed. So I think of several forms of independence. There's that political independence. There's like legal independence. The Federal Reserve Act defines certain things. There's also financial independence. The Fed has seigniorage. It can finance this. It doesn't depend. But the last thing I will call for, maybe there's a better term, but economic independence. The Fed is able to pursue its 2% target without facing fiscal pressures, without being called upon to keep the U.S. government solvent. And so I bring this up because, Marc, when I look at what's been going on, why all this pressure on the Fed? Why is Trump going after the FOMC? It's very different than 2019. 2019, it was about full employment and jobs. Trump has been very explicit. He wants to lower the interest cost on the debt. And there's a number of other things that have been going on. I've mentioned this before in the podcast, but I'll just throw them out there, which to me paint a picture of fiscal dominance coming soon or on the horizon. So one would be, again, Trump's call for rate cuts to help lower the interest costs on debt. But secondly, things like the supplemental leverage ratio tweak, that's been motivated in part by big banks can put more treasuries on their balance sheets. Stable coins, I think stable coins is an exciting development, but it too has been motivated in part by more demand for T-bills. Senator Ted Cruz, he called to end interest on reserves. I question his thinking on this in terms of what actually would happen. But again, he's motivated by fiscal pressures. And then even we see a lot of more T-bills being issued by Treasury, which, it's more cost effective because we're getting all these pressures. Even Treasury market reforms that are going on, they're all there to keep the market resilient and robust. And to me, they're all symptoms of something deeper. So do you worry that maybe we're missing the forest from the trees here? That the real issue is we have a fiscal problem that it doesn't matter who is Fed chair, who's on the FOMC. At some point, they have to become subordinate to Treasury and Congress just to keep the government solvent.
Yeah, well, look, I mean, in terms of the Fed, right, they've been assigned these goals: maximum employment, price stability, actually also moderate long-term interest rate, right? And that third goal is actually viewed generally as a consequence of the first two goals of price stability and maximum employment. So that's why we talk about the dual mandate. And the Fed is organized in a fairly decentralized fashion to withstand basically external pressures and to the pressures to move policy rates one way or another. It was also granted a fair amount of autonomy and operational independence for the conduct of monetary policy. And I do think operational independence is important here in the sense that ultimately, we are accountable to the public, to the people, and the Fed is as well, but it reports to Congress. But in terms of the actual conduct of monetary policy, it has been so far granted operational independence. I think this independence is critical. There is plenty of empirical evidence by looking across countries over time that this kind of central bank independence brings big benefits to society through price stability generally, through more stabilities in economic activity overall and in employment. I do think that there can be legitimate disagreements at all times about the assessment of the economy, about its outlook, about the risks around the outlook. Different policymakers can come up with different conclusions about the appropriate path of policy given their assessment of the economy. But it is, I think, paramount that the FOMC be allowed to do its job, to set the policy instruments in order to achieve basically the congressionally mandated goals, right? Price stability, maximum employment. And I do think now, I mean, you alluded to a lot of changes that are going on. I do think the independence is being tested, and we'll have to see where that brings us. You know, does it bring us to a system where we've tested the limits of the independence and it's a more well-defined, clearly resilient independence of the Fed, or is it not? So we'll have to see where that brings us. But you mentioned about the fiscal situation here and potentially fiscal dominance. I think clearly it would benefit the fiscal outlook in terms of budget balance and in terms of the debt to GDP ratio to see longer term rates be lower. The sense that the interest cost on the debt would be lower. So the budget deficits would be reduced and the debt to GDP ratio would not be growing as rapidly. But as I mentioned before, I think this can happen in a system with low inflation and maximum employment. And in fact, I think the surer way to get to a longer interest rates that are moderate, that are relatively low, is by having relatively low inflation and maximum employment. So I think if the Fed were to cut rates too much with the intention to boost growth to lower the financial cost, if that were the objective, it may ultimately end up creating more inflation and ultimately end up creating higher longer-term rates, which ironically doesn't really help so much with the interest expenses. So I do think a lot of people recognize that, and that ultimately, it's an important consideration to maintain.
Speaking of those long-term rates, if I look at them now, it's the one thing that makes me question my worries about fiscal dominance, because 10-year Treasury still seems relatively low. If in fact fiscal dominance is on the horizon, why is it at 4.2, 4.3? So I have to at least acknowledge that the wisdom of the markets disagrees with me for now, at least, that we're not at the precipice of a fiscal crisis. But let's talk about long rates in general, because you've done some really fascinating work on this. You have multiple papers. I want to focus on two of them. And the first one is a Brookings paper on economic activity in 2017. It's called Safety, Liquidity, and the Natural Rate of Interest. And I believe her co-authors are Marco Del Negro, Marc Giannoni, and Andrea Tambolati. But you do a really fascinating discussion of why our star, or real rates, have fallen. This was focused on the U.S. Let me begin with a very basic question. I know a lot of listeners will know this, but just to set the table, how do you define R star?
Yeah, that's a great question. And yeah, that was really a fun set of projects with these co-authors, at the time colleagues at the New York Fed. So as you said, Marco Del Negro Domenico, who is not my cousin. We share almost the same last name, except for the last letter, Giannoni, yes, and Andrea Tambolati. So we're trying to figure out why interest rates were so low at the time. So this is, around 2016, 2017 period, pre-pandemic essentially, and what that was telling us from about the future. So we essentially approached this from two angles. So on the one hand, we built like a flexible statistical model to extract like long-run trends in bond yields, inflation, expectations. And on the other hand, we had a much more structural model, so-called DSGE model, that is has a lot of detail, lots of moving parts there, but lots of details, lots of data as well used to estimate this model to try to capture underlying economic forces. And I think what was pretty interesting we found basically by working on this project is that both methods gave us a fairly consistent picture. This is as you know, in the world of economics, that's not obvious that if you take two different routes to answer a certain question, you get to the similar results. But in this case, we did. And we found that the natural rate of interest, so that's the way we thought about that, it was, I mean, there are different definitions of that. You could think of that as being the equilibrium interest rate, so that monetary policy is neither accommodative nor restrictive, so it's neutral. We can think of that as the interest rate, or the real interest rate, such as saving, broadly defined, and investment are in balance. We can define it through the longer run trends model as being basically where the trend for the real interest rate is, given all the data that we have. Or in the very structural DSGE model, we can think of really what would be the real interest rates that you would have if the economy were to clear very quickly, if you were not subject to price rigidity, wage rigidities, and other frictions like that. What would be the equilibrium interest rate that you would obtain directly? And for those who are very much into the weeds of econ, remember the good old Phillips curve and ISLM model. You can think of basically where the IS curve is crossing the full employment, essentially. So there are many different ways to think about the equilibrium interest rate, and we had different models to try to assess that in slightly different way, both through the trend model and the DSG model.
And what did you find?
Yeah, no, exactly. So I think first we found that these equilibrium interest rates had been declining quite significantly from the late 1990s. The real rate we assessed to be at about 2.5%, had been there for several decades, right through the mid-1990s. And then from the late 90s through the pre-pandemic period, it basically had been trending down pretty significantly by about 100 to 150 basis points or so. And then we tried to figure out what these forces were. I think a key force we identified there was that there was essentially a rising premium for holding safe and liquid assets like U.S. Treasuries. Again, this is pre-pandemic period. Investors really valuing treasuries, not just for their pecuniary returns, but also for the unique attributes they bring in terms of safety, in terms of liquidity. And then since then, we've seen a lot of models trying to explain that why treasury had these very attractive features that led investors all around the world want to hold them. So we found that this so-called convenience yield had increased pretty sharply, so leading to a lower rate in terms of treasury rates than you would otherwise have basically since the 1990s, and therefore explaining a lower R star than you would otherwise have were there not for that feature of this treasury. So that contributed to, in our estimate, to a good percentage point of the drop in the equilibrium interest rate. The second, we identified slower trend growth, both in productivity and consumption during that period. We think that contributed as well to some of the decline, although less so. We had also demographic factors that played a role with the aging of society as well, at contributing to the lower rate, but less so, and so on. But the bottom line, I think that there were these deep structural shifts and this increased attractiveness of treasuries at the time from the late 90s to just before the pandemic, basically contributing to more demand for treasuries from around the world and this lower equilibrium interest rate. So that's what I think contributed as well to real interest rates being lower, but then monetary policy being potentially more constrained by the zero lower bound. And it underscores, I think, the importance of fiscal policy as well, financial policies, given that the supply of safe and liquid asset is quite central where this equilibrium interest rate settles.
So you noted that the decline in the equilibrium rate, the real rate R star, starts late 90s. So basically the 2000s up to 2020, which one could look at, it's globalization, it's a global demand for safe assets, maybe it's the aging of the planet. So in your mind, what has fundamentally changed since then? Why we won't return, at least in near term, to like a zero lower bound environment? What has altered that trajectory?
So Look, I do think there is a clear distinction between short-term R-star and longer-term R-star. So
Okay.
this is something that, let's say, the DSG model, for instance, that I was alluding to before, can help distinguish. The other more statistical models, I have more trouble distinguishing that. And so when I think about longer-run interest rate, think about these the factors I described, right? Demographic factors, productivity growth. Now, productivity growth is really hard to assess. If you're an
Yep.
optimist, you'll say, well, that's maybe accelerating going forward. And who knows, maybe that's going to contribute to higher R-star. I'm hopeful about the effects of AI, but I don't know that how much of that is going to realize and how much is going to contribute to productivity just yet, right? But the demographic factors, this is something we know, that's
Yep.
contributing to lower equilibrium interest rate. I think it's going to likely continue for some time. The part that we identify as being quite important, this convenience yield part, arguably there's a little more uncertainty about that at this point, given the fiscal outlook we discussed, given the sort of fiscal trajectory. And so I guess there is some uncertainty about the trajectory going forward, but I think it's going to be an important factor to think about when we think about the evolution of the longer term R-star. And then short term R-star, I think of that as more supply demand imbalances or imbalances between saving and investment in the shorter run.
Okay.
And what we've seen in the last few years since the pandemic is initially during the pandemic period, a massive shift of resources from the public sector to the private sector, which boosted consumer spending tremendously, through the checks and various other stimulus programs. Also an increase in investment afterwards and the need for investment, whether it's the energy transition or now, AI investment or whatnot. These forces that are basically really increasing the demand for investment at the same time as the saving from household being relatively muted as households feel wealthy, have gotten these checks and want to spend them. And we had for several years very robust consumer spending. So that in equilibrium basically leads to a higher shorter term R-star. So the way I think about it is that in the short run, R-star is currently quite elevated. If you look at the New York Fed's DSG website, it is going to tell you that in the short run, R-star is probably in real term around 2% now. And it's projected to gradually come down to something like 1.5% or 1% over the coming year. And to me, that makes quite a bit of sense to think about the trajectory of R-star. So we'll eventually converge to a lower R-star again, but we are currently going through we recently went through a period of fairly elevated R-star.
Oh, that's very helpful. And it really answers my questions. Like, did the world fundamentally change in 2020 other than, a whole lot of added debt that was added? And what you said is no, it hasn't. Population dynamics are the same. So if you think of like a basic, like Ramsey growth model or economic growth model, like productivity growth, if it goes up, it raises the R-star because the return on capital goes up. If population growth goes up, the return on capital also goes up. It's positive as well. And those two things really, as you said, haven't changed. And we know the one for sure, at least, is it's going to get worse. Population growth is going down, and that would suggest lower R-star. Maybe you cross your fingers, AI will change the world. But so that was the context of my question. What really fundamentally changed? And you're suggesting, well, maybe things haven't changed as much as the headline numbers show us right now.
Yeah, and I do think that distinguish longer term, shorter term is important. So I think the longer run drivers maybe have not as much yet. We'll see what AI does. Well, no, and maybe that's where I think I agree with Chair Powell. Then we'll see by its works where R-star is at the end,
awesome.
right? We'll probably see that, but it's very hard to predict that part. But I think short term R-star, in my mind, if I look at models, if I look at structural models that take information from investment data equipment data on investment, on productivity, on consumer spending, on employment, and so on and so forth, and rates. These models, like the New York Fed DSG models, for instance, would point out that short-term R-star is probably quite elevated, and has been for the last 3 years.
So let me ask you a really speculative question about interest rates here. So let's just imagine, for the sake of argument, that AI does take off. In fact, rapid growth. We have AGI, artificial general intelligence. So let's just say, for the sake of argument, again, this is extreme. Let's say we get trend real GDP growth of 10%. All right, let's really extreme. Okay. That would suggest real rates would go up quite a bit, right? Now, that would be a great problem to have, because the amount of income growth would be fantastic. It would be a wonderful world to be in.
Yep.
However, if you were Treasury Secretary and you knew that that growth was going to accelerate and real rates would go up, would you be worried about the debt more or less? Because on one hand, you might say, man, we're going to have to finance with higher real rates. On the other hand, there's a bigger tax base to draw income from. Can you help us think through wild scenarios like that?
I mean, I haven't run that exercise, but I would, just thinking like that, I think it's a great problem to have. If productivity growth brings you to a 10% real GDP growth, I think you're going to bring a lot of tax revenues, and people are going to be very happy to pay these tax revenues. And you are going to improve the fiscal situation a lot, even if the interest cost on the debt is elevated. We saw some of that to a much lesser extent, of course, but in the late 1990s, early 2000 years, right? Where for a while we had treasury surpluses and federal government surpluses. And there was actually, and this is the time where, by the way, I joined the New York Fed, and one of the tasks here was to figure out how do you conduct monetary policy in a world where there is no more public debt. So that was the big question of the time, because we thought that at the time that maybe the treasury supply would come down so much that you wouldn't be able to use government debt to conduct monetary policy. So, times have changed. But that gives you just a sense of how, with rapid growth of the late 1990s, there were quite a bit of tax revenues coming in.
Yeah, I remember some of the discussions from back then, and talking to Bill Nelson, who was at the Fed at the time, and he mentioned they were talking a lot about doing more discount window lending, more assets from the banks, collateral to replace the treasury. So very fascinating. All right, let's go briefly to your other paper that I wanted to touch on. Same set of authors, I believe, but this is Global Trends in Interest Rates. This is Journal of International Economics 2019. Maybe summarize that for us.
Yeah, I mean, similar. So what we did here was to use a similar structure in terms of this trends model, and now looking across different countries, US with a range of other countries, European countries, trying to figure out what were the trends in interest rates and how, and account more specifically of the linkages between these different trajectories for interest rate. And unsurprisingly, I mean, we found, similar evidence, right, to even incorporating data from all of these other countries and having a structure that allows for the dollar to play a role, the convenience yield in different regions to play a role, interest rate parity conditions. So thinking hard about those relationships and how to model those relationships in that setup, but found essentially similar results, that longer term rates had moved down across the board, across all these different regions, and was constraining basically the path of policy by the end of this period of the 2010s, basically before the pandemic.
Yeah, we'll provide links to both of these papers in the transcripts. And just one comment about this global paper. You have a chart in there. It's so interesting. It shows the global rates kind of before and after this inflection point, where they're all over the map, very different. But then there's this sharp convergence as they head down. They're not just all going down, but they're converging, which is super fascinating, a lot of work. Now, we are running low on time. So, Marc, I'm going to jump to a topic I've been dying to chat with you about. And this is your ReStat, your Review of Economic and Statistics paper for 2006. And the title is, Has Monetary Policy Become More Effective? And as I was preparing for the show, I found an earlier version of this, which is interesting. In the New York Fed version, it was like, has monetary policy become less powerful? And so I see what you're doing there, but maybe walk us through this paper and then we can talk about it some more.
So this is a set of projects with a great friend of mine, former colleague as well, Jean Boivin. Then we were in grad school together. We're at Columbia together for some time, and now he's at BlackRock. And so we were basically motivated by a few puzzles here. One is something that we saw, first the economy looked a lot calmer after 1980s through this whole great moderation period than it had in the prior decades from the 60s and 70s. And if you did this kind of so-called impulse response functions, trying to figure out, if the Fed raises interest rates, how much of an effect does it have on output and inflation, it appeared that after the 80s, basically, 25 basis point increase in the Fed funds rate did not seem to have much of an effect anymore on inflation and output. And a lot of people were talking about that. This is early 2000s. Talking about that, suggesting that, monetary policy is no longer effective. Look, the proof is in the pudding. You just raise interest rate and look at what happens. Inflation doesn't change, output doesn't change, so monetary policy is therefore not effective on the economy. And we were like, hold on, wait a second. Is it really that the economy has changed to the point that it becomes less sensitive to, let's say, policy changes? Or is it that actually policy is doing exactly what it's intended to do, and it's more effective at actually stabilizing inflation? Because if you think about it, if the Fed is really successful at stabilizing inflation, let's say at 2%, all the time, whenever there is a shock, the Fed is going to change policy rates in order to bring inflation at 2%. What you should observe in the end is the interest rates moving around a lot whenever there is a shock. But if it's really successful, inflation should not move. It should stay at zero. So you should find that the correlation between the interest rates movement and ultimately the gold variable, inflation, falls to zero. And so then the question is, when you do find that that correlation is zero, is it that the Fed is successful, or is it that inflation is really not responding to interest rate movements? So to sort that out, we used a small structured model. Doesn't seem very sophisticated by today's standards, but at the time it looked pretty innovative. And then run that through the machine and basically say, okay, let's shock the system. Let's now change structure of the economy like we estimate before 1980s, after the 1980s, see if that plays a role, or change the policy the way we estimated how it was before the 1980s and after the 1980s. And we concluded, sure enough, that a large part of that change, or this so-called reduction in impulse response functions, was due to a more appropriate policy, or a policy more effectively stabilizing basically policy rates. So a pretty successful policy. So this was, in our view, suggesting that first you cannot just look at correlations.
Yep.
I think that's always an important lesson. But second, that policy had done a pretty good job at stabilizing the economy. And it's important that it continues to focus on these goals.
Yeah. So, Marc, in grad school, I did those vector autoregressions, and one of the exercises was to show pre-Paul Volcker, post-Paul Volcker, and like, man, there's a world of difference. The Fed does matter, and most people intuitively know the Fed does matter at some point. And I know there's rational expectation models, a lot of things you could throw at it, but why isn't it happening? And I read your paper, and it was like so obvious after your work came out. It's identification, right? One of the key things we deal with in macroeconomics, which is different than micro, is it's really hard to identify exogenous changes that aren't influenced by the system itself. So that's why we do these general equilibrium models. We have to do structural models because we don't know.
Yep.
In fact, I don't know if you can see behind me here, I have all these little globes.
Yep.
They represent all the counterfactual worlds that macroeconomists have to consider if we're thinking through all these things. But it's such a powerful insight that the instrument and the outcome are not going to be correlated, or if the institution, the Fed, is doing its job. And it's so intuitive, but oftentimes in casual analysis or on the news or on a blog, people say, oh, look, the Fed's not powerful anymore. I just want to throw out a couple of examples and see if you think this kind of fits the billing. So let's talk about the Phillips curve. Now, I know there's many reasons why the Phillips curve was flat in the 2010s. Some would say it's because inflation expectations were anchored. But the Phillips curve shows a relationship, at least the reduced form one you would estimate with data would show inflation, trying to explain inflation by expected inflation term plus an output gap plus some kind of cost shock or supply shock term. And that slope on the output gap got really flat or really small. And one explanation could be, well, maybe it's simply because the Fed's doing such a good job with inflation is so stable, you're not going to find a relationship between the output gap and inflation. Would that be an example that fits your story?
100%. I'm so glad you bring this up, actually, because that actually ties into another paper, actually, we worked on that talks exactly about that. This is with, again, Marco Del Negro from the New York Fed and another great co-author, Frank Schorfriday from University of Pennsylvania. We were looking at, after the global financial crisis, remember, obviously we had this surge in unemployment, this collapse in output, but inflation didn't fall very much. And at the time, there was a lot of discussion about, the missing disinflation. Why is inflation not falling? And so much was written about that, how bad all these Phillips curve were, that the Phillips curve was dead, made no sense to think about inflation depending on slack in the economy. And so there was a ton of literature about that. And again, coming back to that earlier insight, I mean, this didn't make any sense to me in the sense that if you think about two equations working together, one is the Phillips curve and the other one is a policy basically that tries to provide a stimulus to the economy and maybe some equation that relates activity, if you want, or slack to interest rates. If you are in a world with a forward-looking Phillips curve, that the new Keynesian literature would suggest there is, if in this world you can have a lot of slack now, but inflation does not need to necessarily fall at all if you think that you are not going to have much slack in the future. So why would businesses basically cut prices a lot today if the unemployment rate is high today, if they think that in the future they will have to raise prices again because you're not going to have a slack in the future, and it's going to take time, and there's some rigidity and some slack, and it takes time to adjust these prices. So bottom line, in these forward-looking Phillips curves, as long as you had the expectation that you were expecting the economy to rebound at some point in the future, that the central bank was providing enough stimulus for that to happen, then it was not clear at all that you should be cutting inflation or cutting prices a lot. And so we put that to the test again in a model, New Keynesian model, Phillips curve, with its fairly steep, actually, structural slope of the Phillips curve, shocking the system with a shock like the financial crisis and trying to see how much inflation is actually falling in response to that. And lo and behold, inflation did not need to fall at all very much, as long as the monetary policy response was there to respond to the shock and promise to basically create more activity in the future.
So the key insight or finding or point is that if the Fed is doing its job systematically, you should not find any kind of relationship between your instrument and then your outcome, inflation, even real GDP. So let me take that insight and apply it to critiques of the money supply. Now, I'm not championing targeting money supply, but I do think it adds insight to why did the relationship between money and like nominal income or nominal GDP break down? And I think the answer is, it's the same answer we just talked about. When the Fed's not doing its job, that's when you see the correlation. That's when you see it. So if you go and look at, growth rates of money and inflation or nominal income during, say, the 60s and 70s, it's pretty strong. Same thing, post 80s, there's nothing there. So people would say, oh, there's been a breakdown in the relationship. I would say, well, again, I'm not advocating the targeting of money, but there is probably still a structural relationship. We're just not seeing it in the data. And in fact, I would argue that what we saw in 2021, where money did explode, that's a case, again, I want to be gracious to the Fed here, but because it was unusual, it was a big pandemic. It wasn't a typical mistake per se, but you could say the typical approach the Fed took broke down. And so we could see high money, high inflation and such take place. But to me, that's the better explanation for why we don't see a relationship between money and the economy today. Any thoughts?
I'm so glad you make these points. I wholeheartedly agree with that, and I think I guess Charles Goodhart was making that point, like the Goodhart's law, right? Emphasizing again, if you try to stabilize something, well, if you're successful at it, you'll stabilize that thing.
Yes,
and its instruments, the instrument that you use to stabilize it is may not be correlated with the outcome.
Yeah, so let me throw one other example in because I got to do this example. It's Milton Friedman. He had an analogy called the thermostat analogy. Like, so you have an air conditioning system in your home. That thermostat is constantly operating to keep the temperature at a certain level. Say you set it at 72 degrees in your house. Well, that AC, it's going on, it's going off. It's responding to shocks from the outside. So heat on the outside is affecting. There is no correlation between what the thermostat is doing and the temperature in the room. But man, that thermostat's been working really hard for you all day. Its instrument has been going back and forth. That's a powerful analogy to what the Fed's doing.
Beautiful. Yep. Totally agree with that. I love it.
Well, Marc, this has been a fantastic conversation. It's been a real treat to get you on, and I appreciate you coming on. Our guest today has been Marc Giannoni. Marc, it's good to have you on the program.
Thank you very much again.
Macro Musings is produced by the Mercatus Center at George Mason University. Dive deeper into our research at mercatus.org/monetary policy. You can subscribe to the show on Apple Podcasts, Spotify, or your favorite podcast app. If you like this podcast, please consider giving us a rating and leaving a review. This helps other thoughtful people like you find the show. Find me on Twitter at David Beckworth and follow the show at macro_musings.